Last year, 640,000 Australians refinanced their home. That's a 20% jump from the year before. The single biggest refinancing year in Australian history. And the question I keep getting asked right now is, should I have been one of them? Well, for a lot of Australian homeowners, honestly, yes. So today I want to break down what actually drove that number and what people who moved differently and what it's costing the ones that didn't. Most Australian homeowners fall into one of two camps. The first camp treats their loan like an active financial position. They know what the market is offering, they know when a better deal appears, and they're not emotional with their strategic opinion. And the second camp sets up their loan, got on with their life, and assumed that if something better came along, their lender would let them know. That second assumption is an expensive one. Lenders do not call their existing customers in most cases to offer them a better deal. Banks are businesses. Their job is to protect their margin. And if you're sitting with a loan at 0.4 to 0.5, even above 0.7, what they're offering to new customers, they have no financial incentive to tell you. The 640,000 Australians who refinanced their mortgage last year figured that out. A lot of them have been in the same loan for 3 to 4 years and some longer. When they finally looked at what other lenders are offering and that's available to them, the gap was completely significant. That's a huge thing. And here's what refinancing actually looks like in practice, because most people assume it's a massive process when it isn't. In most cases, refinancing doesn't mean starting all over again. It means replacing your existing loan with a better one, and sometimes with the same lender, and more often with a different one. The process involves a credit assessment, a property valuation, and some paperwork. A broker manages most of it. For an active homeowner, it only requires them to input as little as 1 hour's worth of time, and the broker would do the rest for them. On a $600,000 loan, at 0.5% difference in your interest rate saves you roughly $3,000 per year. Over 5 years, that's over $15,000. Over the life of a 25-year loan, the compounding difference would generally surprise most people. But here's what matters most right now. Rates have already risen twice in 2026. The cost of doing nothing has increased, and the gap between what loyal existing customers are paying and what competitive lenders are offering new borrowers have widened. The homeowner who has moved last year locked in a better structure before those hikes. The ones that have waited are absorbing the full impact, and the ones that have waited absorb the full impact on the loans that have already not in their best opinion. Step 1, the starting point is always the same. Understand what's actually going on. Pull up your home loan, find out your current interest rate, then go online and look what competitive lenders are offering equivalent loans right now. If there is a meaningful gap, then it's a conversation worth having with your lender. Step 2, get a broker to run a comparison, not a bank, a broker, because a bank will only show their product. A broker will show the full market. A really good broker will also run switching cost analysis. They'll add up the discharge fees, application fees, and any cashback offers that are applicable on the table and tell you your net position. Sometimes switching costs into your savings short term. A broker will tell you that when that's the case. And the third understanding is that refinancing isn't about just the rate. A lot of the 640,000 people who moved last year were only thinking about structure. Structure is key. Structure is what gets you ahead, and structure allows you to pay your mortgage off a lot sooner. The interest rate is just a headline. The structure is where the long-term value actually sits. So 640,000 Australians refinanced last year is a record, and the common thread across almost all of them was simple. They looked what they were paying, and they looked what else is available, and they made a decision based on their information. The homeowners in the best position right now aren't the ones who are guessing correctly about what rates are going to go. They're the ones who are refused to leave their current loan on autopilot. If you haven't reviewed your home loan in the last 12 months, this is a prompt. Start looking. Review your finances. Look at your internet banking. Speak to your broker. Not because refinancing is always the right answer, but because knowing where you stand will cost you nothing, and not knowing will cost you more than you think in the long run.